Hi folks, Chuck Gibson from Financial Perspectives in Pleasanton, California with May 2016's Charts on the Move. This video is coming out a bit later than usual. Partially it's because of the fact that the first of the month fell midweek, but mostly because I've struggled to find relevant and new content. As such, I'm going to keep it ultra short. The bottom line is the U.S. markets have been in a 2-year sideways consolidation, effectively going nowhere, and providing little gains other than for those who are able to capture short-term individual stock or sector rotation moves. If you remove short-term trading from the list, making money on longer-term opportunities has been hit or miss. The investing bromide of the trend being your friend has been validated once again, as no one is able to make money as markets go sideways. Heck, even Warren Buffett, the beloved leader of Berkshire Hathaway, has lost 6% since December 2014, while the S&P 500, it's essentially flat, with a gain of less than 1% during that same period. I wanted to kick this month's video off by first taking a look at EFA. For those not familiar, it's a proxy index for the world's stock markets, excluding the US and Canada. As you can see in the chart, it's been an ugly past 2 years for the index, as after creating a double top, support gave way, losing almost 24% peak to trough, but it's currently off just 11% from its highs. What should jump out is the stair-step decline. It formed lower highs and lower lows. The red 200-day moving average is clearly sloping downward, and the price action has yet to provide any hint a bottom has been made. Until then, it's my opinion, only those wishing to lose a finger or two should be imbibing in world equities. Switching gears back to the U.S. markets and looking at the end-of-month S&P 500 action, we see price sits near the psychologically very important 2100 level, and at the very top of this trading range. A break and hold above the upper level of that range would be very bullish, as it would indicate the bull flag pattern is in play and to expect a push higher, likely to new highs. On the bearish side of the argument, we have negative divergence and this substantial overhead supply that could put a damper on things and must be addressed before any thought of new high occurs. For client accounts, because we're long-term investors rather than traders, I use longer weekly or monthly time frame charts, which is what I want to show next. This chart should be familiar as I've shown it before. It's a 20-year historical look at the S&P 500 with 3 indicators I use to help identify trends in entry or exit levels. To reorient you on the chart, we have RSI momentum in the top pane, the actual price of the S&P 500 in the pane below that, followed by the PMO price oscillator in the third slot, and finally the MACD plot in the lowest pane. As you can see, all 3 indicators have triggered a sell signal with their signal lines all sloping downward. Notice also how RSI has provided a warning at the start of each decline with negative divergence, and has made another appearance in the most recent top starting last year. This confluence of equivalent signals is providing the warning of a potential top is in place and a cautionary stance towards U.S. equities. Looking to the left, you can see there have been only 2 other times in the past 20 years where this has occurred, and each time it signaled the end of an uptrend and the beginning of a serious decline. Whether this time is a repeat or not, only time will tell, but as such, as a minimum, it's acting as a warning and continued caution of taking on too much risk. With longer-term charts, it takes much longer for these changes to occur and declines to develop. It's kind of like turning a huge ocean liner with an oar. It's a slow, painful process. In June, the U.S. expansion turns 84 months old, which is right on a 7-year mark. This is now the 4th longest expansion since World War II, with an average one lasting 62 months and the median one 58. Common sense would state the longer the expansion goes, the closer we are to the next downturn. However, we don't live in common sense kind of world anymore. My belief is that the Federal Reserve and the other central banking buddies have made it their outright mandate, above inflation and employment data, to keep this expansion going for as long as possible. Eventually, though, markets will refuse to play the easing game, and a financial shock could easily fabricate another meaningful slowdown in global economy. With debt levels higher than in 2007, we should be asking ourselves if the next downturn will be worse than that of 2008. From a seasonality standpoint, we are quickly rolling into the summer doldrums, and as such, we're more likely to fall into a trading range than make big moves in either direction. The big institutional decision makers are headed to the Hamptons for the summer, and they're leaving their portfolios on autopilot. If the market is to go higher, though, we'll need the traders to buy this market with enough enthusiasm to break through a stubborn 2100 resistance level. So, until we get better clarity about the market's intentions, I feel we're better off waiting for a more attractive opportunity, than trying to force a bullish or bearish bet here. If we roll over, expect the profit taking to push us back down to the 50-day moving average. On the other hand, if we keep bumping up against the 2100 resistance and there isn't much selling pressure, I could see a move to push above all-time highs. Both of these moves, though, only account for about a dozen points. So I don't expect an explosive move in either direction. Any explosion will likely only occur on a news-driven event or when the big boys return from vacation when bearish sentiment is seasonally at its peak. Well, that's it for this month. I told you I was going to keep it short. As always, I appreciate your time and your attention and hope you found this video informative and helpful. If you have any special requests for the next installment or comments, I'd love to hear from you. You can send me an email at chuck@financialperspectives.biz. Again, thanks for listening, and until next month, this has been Chuck Gibson from Financial Perspectives with May's Charts on the Move.